On this hot sheet, I discussed the latest CPI report, a decline in asking rents, and unemployment rates. Today is Thursday, August 10th, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome back to the hot sheet. Remember, the best way to support this show is to share it with someone who wants a 24-hour look back on housing. Love for you to hit the thumbs up. And if you're in the live chat, let me know which market you are tuning in from. Dawn says she's on the road to CT this morning. I'm actually back up in CT. I was in Naples yesterday. I guess I'll be in CT tomorrow, but I'll be back in Naples for this weekend. So enjoy your trip to CT, Dawn. Good morning from Marin County, California. Tucson, Arizona. What did I say? Marin. Well, I've never been to Marin. It sounds like a great place, but Marin might be great as well. Cleveland in the house. What's going on, Bob? All right. Also in the house is a CPI data report. This is a big report. We're awaiting these every single month to see what the FOMC, what Jerome Powell is going to do about inflation, what they're going to do with the federal interest rate. A couple different ways to look at this report here. Now, this is the report for July. Okay, we'll go right into the actual report from the Bureau of Labor Statistics and break it all down. But there are a couple of headlines that you're going to see today. One of them being inflation rises for the first time in 12 months. Okay, I like that they're putting the caveat here. It's not as bad as it looks. This is CNBC. Make it. Okay, so yes, inflation did technically go up. We don't want inflation going up. So why is it not as bad as it looks? Okay, so last month, year over year inflation rate was at 3%. This report comes out and it's now at 3.2%. Okay, so it's still above the Federal Reserve's target of 2% total. We're at 3.2 now. We were at 1%, almost getting into that under 1% range. But the increase is due in part, reading off of CNBC, to the way energy costs are accounted for in the report, as year-over-year inflation no longer reflects the dramatic climb down from peak prices in June 22, when average gas prices hit $5 per gallon. Good thing we're not there anymore. While rising oil prices are an ever-present concern, recent energy price increases have been amplified in the year-over-year inflation numbers. Okay, this is a PNC Financial Service senior economist. Similarly, I don't even think I said that word right. Similarly, holy smokes here. Housing costs have cooled in 2023, but there's a months-long lag in the way data is represented in the Labor Bureau reports. We've been talking about this a whole bunch. This lag is actually infuriating. When we go to the news release from the Bureau of Labor Statistics, okay, last month, this line here, the same exact, they just basically copy and paste here and change some numbers around. Last month, this line here was at 70%. Now it's at 90%. And it's complete and utter baloney. The index for shelter was by far the largest contributor to the monthly all items increase, accounting for over 90% of the increase. Okay, now it's not, what they're reporting here is not baloney, but their data is so old, it's lagging. Remember, we have Jeremy Knight is late, but he's here. Do we have the link down for Jeremy's event? We need that link down below. I mentioned that yesterday. I don't know if we got that in there. I'll be in Austin on September the 8th. Speaking of Jeremy Knight's event, can't wait to be there. There's a whole list. Broke Agent will be there. Jimmy Mackin will be there. But anyways, Jeremy's late, and really the Bureau of Labor Department here, the Bureau of Labor Statistics is late to the party on what's going on with inflation. We've been since March talking about what Barry Sternlight has been talking about, amongst others, that inflation, this is from March. I've shown this a number of times. Year over year rent growth is coming down. We'll get into that in a second. And then they have the CPI inflation, CPI shelter going up. They still have it going up, but actual rents are going down. Actual rents have, since March, have really gone down in a much more significant way. But we're still showing this old data. Remember the Wall Street Journal story that we talked about here on the live stream last month that reported if we were tracking our CPI similar to Europe, where we get out of, and this is from the Wall Street Journal, if we stop using imaginary method of how we account for owner's equivalent rent. Owner's equivalent rent is an imaginary made up number from homeowners of what they think they could rent a similar house for from the one that they own that they've never sold. They're not a property manager. They're not a real estate professional. They're a homeowner. Hey, what do you think you'd rent this place for similar to yours? And that's how we're coming up with this data. It's a phone call system that's been around since the 80s. When we have apartments.com, when we have CoStar, Jay Powell, you could call CoStar, you could call Andy Florence at CoStar and just ask him a couple simple questions about what's going on with rent instead of weighing so much on this CPI report. Again, they've got us here now at the index for shelter, the largest contributor to the monthly all items increase, accounting for over 90% of the increase. So this increase, which, by the way, the good news, the second way to look at this is that it's less than expected. The expectation was 3.3%. Okay, so we beat expectations at 3.2% year over year inflation, and we are above where we were last month at the 3% but we've beat expectations. This will be down below for you in the daily download. You do see the year over year little slight increase right there. All items less food and energy did come down just ever so slightly. The all items number, that's where the number we're trying to get to 2%, did pop from 3% year over year to 3.2, but we are under where we were expected to come in at 3.3. So that's good news. Now let's just take a look. Let's dive into the report and take a look at some of the numbers in here. The shelter index was the largest factor in the monthly increase in the index for all items, less food and energy. Among other indexes that rose in July was the index for motor vehicle insurance. A lot of talk about insurance lately, especially for those of us who have cars registered in the state of Florida, which increased 2% after rising 1.7% the preceding month. The indexes for education and recreation also increased in July. Several increases declined in July, led by airline fares index. I don't know. It's just on a plane last night. Didn't feel that way. Delta, which fell 8.1% over the month. Its fourth consecutive monthly decline. The index for used cars is a big one, and trucks fell 1.3% in July. So used cars decreasing again after a decrease of 0.5% in June. The communication index declined 0.1% over the month, as did new vehicles index and the household furnishings and operations index. Household furnishings is another indicator, and we're going to get into rent in a second, that things are actually softening up a little bit more. Okay. That's like kind of the way I would look at that as a leading indicator. All right. Going down to the bulk of the numbers here. Shelter makes up 34.7. So shelter makes up over a third of total inflation. Okay. Now, month over month, we were flat. It went up 0.4%. That's the same last month. Okay. That's the number all the way to the right. This is the report directly from Labor of Statistics. Rent of primary residence went actually down from 0.5 last month to 0.4 this month. Okay. And then owner's equivalent rent of residence, which makes up over 25% of all inflation. It's the largest part of this shelter. It's the one that just makes absolutely no sense. It's that stupid, silly survey of what, an imaginary cost made up out of thin air by people who don't even, just regular homeowners that don't have a clue what's actually going on in their relative market, that went up month over month from 0.4% to 0.5%. In their defense, that they're not supposed to have a clue. These are just homeowners like, hey, I'm just like going to work, taking care of my family. And you're calling me with this question. I don't know. It cost me $1 million. Screw off, government. Like, get out of my way. This is the dumbest, measurement that we could be doing. And it makes up such a large portion of this CPI data. So hopefully the lagging data will catch up, as it takes a while for this survey to catch up, where it's like, oh wow, rents are coming down for a variety of reasons. Let's get into some of those reasons. Why are rents coming down? And they have been coming down. One of the reasons is the vacancy rate is going up. The vacancy rate is going up right now at a time when inventory is about to increase dramatically before the end of the year. Remember, places like Nashville, Houston have a lot of multifamily inventory coming online. It's where the majority of the inventory, when Powell at his last press conference said there's a lot of inventory coming online, this is what we have to assume he's talking about, is the multifamily inventory. So I can only expect vacancy rates to flatten or go up by the end of the fourth quarter. We know that year over year rent is coming down, and it's coming down dramatically. It's coming down it's just fast as it went up. Okay. National single family rent index year over year, percent change by price tier. This isn't just happening across the board, but it's happening on single family rents, low tier, low middle tier, high middle tier, and high tier. They're all coming down as fast as they went up. Low end rental prices were up, though, 5.6% compared to the high end price gains of 2.1%. Just because they're coming down, the appreciation is coming down. Some of these categories can still be up. And then here, how about asking rents? How is this not a great indicator for where rents are going? Asking rents, month over month change in U.S. Apartment asking rents are coming down and coming down each and every single month. All those will be available for you in the daily download. Okay. Also reflects this overall trend that inflation is on a downward path. It is potentially stickier than we want to believe, or we want it to be. We want to hope for it to be. Certainly the 0.2% increase is not what we wanted. We're hoping for like it just continue to go down. But if you look back in time here, you have some months that are, higher than others. On a month over month, you can get some of these increases, but we've got the smallest back-to-back monthly gains in over 2 years. So those will all be available for you in your daily download. If you're a BAMX member, just use the code HOT to get 10% off of BAMX. All that commercial real estate is turning into multi-unit. We discussed this a little bit yesterday, and there's a white paper report that went out. Somebody from NYU said that looking across the country, 11% of office buildings can be deemed as a fit for multifamily apartment. And that's only really even possible if policymakers want affordable housing. You can go listen to yesterday's hot sheet to talk about that. But yeah, not all commercial property can be turned into certainly affordable multifamily housing. A lot of it would have to be in the luxury sector because of how expensive it would be. And then you need policymakers to play ball. And do they listen? I'm not trying to be conspiratorial, but do they want more renters or do they want more owners? What indication do you get out of both sides of the aisle? Do they want to control you more or less? And so it seems like they make every advantage for, an increase in inventory from the apartment standpoint and not as much from the home ownership standpoint. And then they get up there and say, well, this is a great thing for affordability that more apartments are coming online. This is trapping people into being 44x less wealthy than the homeowner. It's trapping people from relying on, entitlements that may or may not be there for them come retirement time, as opposed to having a few different buckets, a 30-year fixed rate that I pay off and now own this asset that appreciates over time. Maybe I own some other investments over here, some stock, and then maybe, just maybe, I have those government entitlements at the end of my tenure of working. If you're just relying on that, and you certainly don't have the bedrock, the housing, the place to live that's paid off, Dave Ramsey style, it's probably going to be pretty disappointing in the end. Jody from OKC says, remember they said you will own nothing and be happy. I mean, maybe you can own nothing and be happy, but my point is here, I just don't see a lot of, and we need policymakers for the example, like zoning is a big issue with some of these commercial buildings. And then if the investor is going to go put all this money into the property and help out the bank, because, remember, regional banks are holding a lot of this property. If they're in trouble, then the economy could be in trouble. Everybody's kind of got to help each other out on this deal. And so there might need to be a tax break for a year or two on some of these buildings so that they don't come out as luxury apartments. We don't need more luxury apartments. I can promise you that right now. Okay, so that's your CPI report and the asking rents, total rents. They're on the opposite end of the spectrum. 90% of CPI is made up on this shelter, yet rents are coming down. What is going on there? Who the heck knows? Let's take a look at unemployment insurance weekly claims, because this is something we need to watch closely. The jobs market's going to impact rates probably the most significantly. In the week ending August 5th, just released here this morning, the advanced figure for seasonally adjusted initial claims was 248,000, an increase of 21,000 from the previous week's unrevised level of 227,000. The 4-week moving average was 231,000, an increase of 227.50. Okay, so unemployment up more than expected. Unemployment up 21,000 from the previous week. Might say that's not that big of a deal. Certainly doesn't seem like it when we have 3.5% unemployment. Doesn't seem like it's a big deal at all when we have a job surplus out there. Interesting, though. There's been a couple of earnings reports lately. It's like a lot of earnings are coming out, and there's been some earning reports from some of these big job companies, some of these big hiring companies, where internally they're laying off, where internally they see a downside for them. Think Wise Hire, Monster, like these types of companies, where they see and they're warning investors that there's a down market ahead for them. Why do they see that? Obviously, they see less advertising coming through their portals. They see a leading indicator potentially that there are less business owners that are going to be hiring into the future. Now, this is just 1 week example. The job market's been very strong. It's been one of those things that it's like we might have a soft landing, avoid recession, strong job market, but yet cooling inflation. The Fed has cautioned many times, though, to get inflation down to 2%. We might need to see, more loss in the job market. All of the, measurements from the restrictive policy have not been felt yet with what they've done, kind of warning that there could be job loss in the horizon. Certainly, if we get into a recession, if we have, don't have a soft landing, we get into a recession, you would expect job losses. And so it was just interesting to see some of those reports that these hiring companies are not bullish on their future. They're cutting back on jobs, and they're doing it now, and they're not seeing strong growth from business owners, despite the fact that there's 9 million job openings up there. Seems like they would be opposite, but this might be a preview of potentially some job loss coming. We're coming up from, an all-time low here on unemployment. But, just something to think about. Now, when we look at interest rates, there's one way, and Lance Lambert said it on Knowledge Brokers podcast, one way to get rates coming down the fastest. That is like job loss and recession. We also don't want that, because then less people can go out there and create an investment, a buy, a sell situation in real estate. Might create some scared sellers, which I don't think anybody's rooting for that. Nobody wants inventory in light of job loss. All right. What is the 10-year doing off of the news here today? It's down a tick. It was down below 4%. And literally, when I just switched my screen, it ticked back up to 4%. Let's see if we can get it to drop down. There it is. There it is. Thank you, Wall Street Journal. 3.998 on the 10-year. It's good news. We got back under 4. Yesterday, we were at 7.05 on the 30-year fixed. All right, if you want these kind of updates, today was a little bit more economic driven. Not much going on specifically for housing. But if you want these daily housing updates, this is the only live daily housing show on the internet. Make sure you subscribe. If you want our best content, we had a live stream yesterday. How was the live stream, Bobby, in BMX? All right, so
a lot of people learned about podcasting.
We had podcasting live stream in BAMX. You can get into BAMX for coffee money, and basically you can get 10% off of that by using the code HOT down below. That'll also get you 25% off of BAM Camp in September, which this is potentially the most ridiculous lineup ever put together. Okay, BAM Camp is going to be price is going to be going up next week, by the way. And look at these speakers. We have 20 speakers for an intimate group. Okay, this is going to be this is just going to be an unbelievable experience. We will absolutely over deliver like everything that we do at BAM. And BAM X members get 25% off when they go ahead and purchase a BAM Camp ticket. So if you're not a BAM X member today, make sure you go and do that 10% off using the code HOT. And we're a couple weeks away from the Tom Ferry Summit, which I can't wait for. August 22nd, we'll have BAM Bash out there. If you still are thinking about the Tom Ferry ticket, we've got a link down below, PRBAMSS, to get $100 off of that ticket. Love to see you out there in Dallas in a couple weeks. Appreciate you guys tuning in to today's Hot Sheet. And until tomorrow, toodaloo.